Hello and welcome to a new episode of Under 360 English channel. This is the second episode of the currency trading tutorial. Today we are going to discuss about the advantages of currency trading when compared to the equity or index F&O and the essential terminologies you should know in currency trading. Keep watching. First, let's have a look on the advantage of currency trading. So, NSE currency segment itself, that's a F&O. But unlike our NSE futures and options in index as well as stocks, the margin requirement is very low. For example, if you want to sell a put option for USD INR of a strike price to say 76 rupee 50 paise, the margin requirement is anywhere between 2000 to 3000 rupees only. I do admit that the premiums are also less. But you just imagine what's the premium you have to keep in your account or the fund deployed if you want to sell an index option. It's nearly 1 lakh rupees. So instead of 1 lakh, you are just deploying the funds 1 by 50th only. So that's the main advantage of this. So with lower funds itself, you can theoretically do currency trading. Second one is, as we have discussed about the currency option selling. Since the volatility is not high as compared to equity or index F&O, the probability for ending up in profit as a seller, that's relatively very high. And let's move to the essential terminologies that we should know when you enter into the currency trading. Some of the terms we have discussed in the last episode itself, that means in the episode 1 itself, but still I just want to discuss it here also just for the sake of comprehensiveness. The first term is the currency pair. In the last episode also we have discussed it, but still we can discuss now also. So in forex market, you cannot buy or sell a single currency as such. You can't buy US dollar alone, or you can't buy Great Britain pound alone. It's always the trade goes as a currency pair. So this is one of the most basic things to keep it in mind when you trade in currency. So currencies are always traded in pairs, and obviously each such set is known as currency pair. So an example for currency pair would be USD INR pair. That means US dollar Indian rupee pair. So when you buy the USD INR pair, basically you are buying the US dollar and selling the rupee, because you are giving as a rupee for purchasing that particular pair. So whenever you place a trade in a currency market, you buy or sell a currency pair, and each pair has two currencies, a base currency and a quote currency. Now let's have a look on what is base currency and quote currency. The base currency is the first currency that's mentioned in the currency pair. For example, in the USD INR currency pair, the base currency is USD. Then what about quote currency? The quote currency is the second currency in the currency pair. For example, in the previous case itself, in USD INR, the INR is the quote currency. The fourth term is the exchange rate. Exchange rate is the rate at which one currency is exchanged for another currency. So it is the value of one currency expressed in terms of another currency. For example, if USD INR pair is 75 rupee 19 paise, that means 1 US dollar is worth rupees 75 rupee 19 paise. When the exchange rate of a currency pair rises, it indicates that the base currency is gaining value against the quote currency. Consequently, it means that the quote currency is depreciating against the base currency. And conversely, when there is a decrease in the exchange rate, that implies the base currency is losing value against the quote currency, and that's the quote currency is appreciating against the base currency. I hope that's clear to you. Let's make it clear with an example. Assume that the exchange rate of USD INR pair is 75 rupee 19 paise today, and tomorrow assume that it increases to 76 rupees. That means today you can buy 1 US dollar with rupees 75 rupees 19 paise, but tomorrow for the same US dollar you will have to pay rupees 76. So the USD has appreciated in value and the Indian rupee has lost its value. I hope now it's clear. The fifth term is cross rate. An exchange rate that does not involve the official currency of the country in which the quote is published and used in known as the cross rate. For example, let's consider an example where you are engaging in currency trading in India. Say you open your daily newspaper and find the following rates listed. The rates are like this: Great Britain pound, euro 1.12, Great Britain pound, Japanese yen 134.48, euro versus Japanese yen is 120 rupee 52 paise, US dollar versus Indian rupee 75 rupee 25 paise, Great Britain pound versus Indian rupee is 94 rupee 78 paise. Here the entries from 1 to 3 are all cross rates since they don't mention the Indian rupee. But entries 4 and 5 are not cross rates since they pertain to be official currency of India. Similarly, in the US, the Euro Japanese yen or Great Britain pound euro exchange rates will be considered as the cross rate. I think that's also clear to you now. The sixth term is pip. This is another key term to be aware of when you trade in currencies. Technically speaking, a pip is basically a short for percentage in point. It is the smallest unit of price for any foreign currency and it is generally refers to the digits that are added or subtracted from the fourth decimal place of the rate. For example, 1 pip for the Great Britain pound USD pair is equal to 0.0001. So, say the pair is currently trading at 1.26433. It then moves to 1.26443. This means it moved up by 1 pip. But most yen pairs have their pip located at the second decimal point. So for the USD Japanese yen pair, 1 pip would be 0.01. Seventh necessary term you should know is pipette. A pipette is 1/10 of a pip. In other words, it's the fifth decimal place in the currency pairs exchange rate. In case of yen pairs, it will be the third decimal place. Because for yen pairs, the pip is the second decimal place. The eighth term is the bid price. The bid price is essentially the price that the market is willing to pay for an asset. In currency markets, it's the price at which you can sell the base currency in a pair. The ninth term is ask price. I think those who are familiar with the equity markets, this bid price and ask price must be familiar to you, but still we can discuss it. The ask price is the price that the market is willing to sell an asset. In the case of a currency market, it is the price at which you can buy the base currency in a pair. The bid and ask price are generally represented together. Like in this case, it's a USD INR 76.3475 slash is 76.3775. This means that the highest price of the buyer in the market is willing to pay for the US dollar is rupees 76.3475, but the lowest price a seller is willing to sell the US dollar is rupees 76 rupee 0.3775. The 10th term is spread. The difference between the bid price and ask price is called the spread, or more specifically, it's a bid-ask spread. The spread is a very important concept when you trade in currency. In the last example, you can say that the spread is 0.3. The 11th terms are very much familiar to you if you are in equity markets. That's a long and short positions. Taking a long position means that you buy a currency since you expect its prices to rise in the future. That's also referred to as going long. And in a short position, on the other hand, means that you sell a currency today expecting its prices to fall in the future. So you can square off your position by buying the currency back for a lower price at a later point. The 12th term is lot. Like derivatives in equity or in index, currencies also are traded as lots. A standard lot in the forex market is 1 lakh units. But still, other options are also available like mini lots for 10,000 units or micro lots for 1,000 units and even nano lots, that's 100 units. The 13th term is the tick size. So it is the minimum amount of movement in the price of the currency pair. So knowing the tick size help you to take informed trading positions. When you know the tick size and the contract size of a currency pair, you know how much the price can move at any particular point in time. The next term is the final settlement day. This refers to the trading day when your currency derivatives expire. You know that how the stock futures and options. The settlement or the expiry generally occurs on the last Thursday of each month. In the case of a weekly settlement, that's on all the Thursdays. Just like that, for currency derivatives also, the settlement day is generally the last working day of the month with regard to currency trading in India. And the last term is the settlement price. This basically points to the price that determines your profit or loss at settlement. So generally the RBI reference rates are used as the settlement prices. If you are taking a long position, you make a profit when the contract price is less than the settlement price. On the other hand, if you have taken a short position, you may make a profit when the settlement price is less than the contract price. So just quickly wrap up what all things we have discussed today. One thing is, in the forex market, you cannot buy or sell a single currency as such. Currencies are always traded in pairs. Second thing is, the base currency is the first currency that mentioned in the currency pair. Third one is, the quad currency is the second currency in a currency pair. Fourth one is the exchange rate. It is the rate which one currency is exchanged for another. Fifth one is, when the exchange rate of the currency pair rises, it indicates that the base currency is gaining value against the quad currency. On the other hand, the quad currency is depreciating against the base currency. When there is the next point is, when there is a decrease in the exchange rate, that means the base currency is losing value against the quad currency and that the quad currency is appreciating against the base currency. The 10th point is the exchange rate that does not involve the official currency of the country in which the quote is published and used is known as the cross rate. Next point is, a pip is the smallest unit of a price for any foreign currency and it generally refers to the digits that are added or subtracted from the fourth decimal place of the rate. The next point is the pipette, that is the 1/10 of a pip. Another point is the bid price is essentially the price that the market is willing to pay for an asset, and the ask price, it is the price that market is willing to sell an asset. And also the difference between the bid price and the ask price is called as spread or bid-ask spread. 11th point is, taking a long position generally means that you buy a currency since you expect its prices to rise in the future, and in short position, on the other hand, means that you sell a currency today expecting its prices to fall in the future, and in future you will buy it and square off it, take the profit out of that trade. The last one is the tick size, that refers to the minimum amount of movement in the price of the currency pair. So I hope you got an idea of the terminologies that involved in currency trading and the advantages of currency trading when compared to F&O trades on equity and index. So that's all for now for today's session. We shall meet in the third episode of currency trading. Till then, bye from Anup.